Welcome back again, WSU Vancouver VITA volunteers. We're back with another advanced topic. Now, if you haven't watched the basic lessons, you'll want to go back and do that as the advanced material builds off of the lessons that we covered in the basic certification. So this lesson expands on our adjustments to income, and when we were doing our basic adjustments to income, we learned 4 adjustments. One for educator expenses. We learned about one based on penalties paid to usually banks on early withdrawals. We learned about alimony adjustments and student loan interest adjustments. In this lesson, we're going to cover 4 new kinds of adjustments. One couple based on self-employment. So we'll cover a little bit about the self-employment tax and then go into the accompanying adjustment. And then there's another adjustment for self-employed health insurance. And then we have some adjustments that are related to contributions to some tax-favored accounts, including health savings accounts and individual retirement accounts. So a little note, if you are watching these in the order that I am releasing them, our advanced material does kind of bounce around a little bit. We are going to cover some additional income topics after this lesson, so it's not ordered quite the same as our basic material where we really followed the structure of the 1040. But I ordered this one right after we covered our 2 business income lessons, just because, you know, as we're learning about reporting income for a business and the associated expenses, these 2 adjustments in particular are really related to that. So I wanted you to have that material fairly close together. So our self-employment tax and adjustment and our self-employed health insurance deduction occur on returns where we will have a Schedule C, which again we just covered in our business income lesson. And when somebody comes in with this type of return, we'll notice on their intake form, Form 13614C, on page 2 in the income section, they'll be checking yes to having self-employment income or possibly some other income, cash or check or other property or services received for work that they performed that wasn't reported to them on either a W-2 or a 1099. And then in particular for the self-employed health insurance deduction, we would also be noticing in that expenses section that they're saying, yeah, I have some medical and dental expenses, including insurance and premiums. And then, of course, a little further down, we just have blanket expenses related to self-employment income or other income that you received. So these are the boxes that we would expect to be checked that will cue us that we might be looking at these types of adjustments. So when our self-employed individuals have calculated their net income from Schedule C, if they had $400 or more of that net income, they are going to need to calculate the self-employment tax, and there's an accompanying deduction, an adjustment to income that goes with that. And the self-employment tax is really just Social Security and Medicare tax. And in the case of an employee, the employer paid half of it, and then the other half was the employee's responsibility. But the employer also withheld the employee's portion from their paychecks and submitted all of that. But that process didn't take place for our self-employed taxpayers, so they need to do it on their return right now. And the accompanying adjustment levels the playing field between our employees and our self-employed taxpayers. So when the employer paid half of the self-employment the Social Security and Medicare taxes, they did not report that as income to the employee on their W-2 in box 1. So for self-employed individuals, they get an adjustment to income to also decrease their income that's reported by that employer's portion, even though they were the employer. So that makes everybody's reported income kind of at a fair level playing field. So TaxSlayer will automatically calculate this out for us. However, we still need to understand what's happening on the return. We should be at the end of every return pulling up a preview and double checking the forms and making sure that our inputs are coming through onto the forms where we expect them to go. And then also when we explain the returns to our taxpayers, we need to be able to confidently walk them through what is happening on their return. So this is what Schedule SE looks like. And you'll see just some highlights here. Box 2 or line 2 flows from the Schedule C, and so that's where the net income flows in. And then line 4C is where that $400 threshold will show up. So if the self-employed person didn't have $400 of self-employment income, that's where they will stop having entries on this form. I don't have highlighted there, but line 7 is where the upper threshold, the upper limit on the base for Social Security tax is. So employees and self-employed individuals, when they pay Social Security tax, they only pay Social Security tax on the first $142,800 worth of income. And then line 12 is where, after all of these calculations come through, the tax has been calculated, and that's going to flow onto Schedule 2, other taxes, and then onto the 1040. And line 13 there is where the adjustment, the 50% of the tax, is calculated, and then it will flow on to Schedule 1 for other income and adjustments. For the purposes of this lesson, we're not going to go through the flow through of Schedule 2 for the other taxes, and we're just going to focus here on Schedule 1, which is our other income and adjustments to income. And so you can see here on line 15, that's where we have the deductible part of the self-employment tax flowing from Schedule SE. And then our next line of interest is the self-employed health insurance deduction. And so that's where our self-employed individuals will get to deduct, or may get to deduct, some or all of their self-employed health insurance costs. Because again, an employee, if they are purchasing health insurance, or if their employer is paying for health insurance for that person, then that the cost of that insurance is not included in that employee's income. And so again, keeping a level playing field as much as possible between our self-employed individuals and employees, we're going to allow the self-employed individuals to have an adjustment to their income. Now, there are some limits on how much a taxpayer can take for the self-employed health insurance deduction. So first of all, they have to report a net profit from their trade or business on their Schedule C. Otherwise, they wouldn't be able to take this. They can't use this deduction to create an even bigger loss. And then they can't take any more than the earned income from that trade or business. So even if they did report a profit, they would be limited to the amount of that profit, and the profit must specifically be earned income. So the way that we calculate the limit is the self-employment profit on the return, and then we subtract out half of the self-employment tax. Remember, that's the same amount that we took as an adjustment. And the difference there is the limit that the taxpayer is allowed to take of self-employed health insurance deduction. Now, if they can't take the full amount as a self-employed health insurance deduction, it may be possible that they could deduct the remainder on Schedule A as an itemized deduction. And in a later lesson, we'll learn a little bit more about Schedule A and itemized deductions. And there are a few more rules regarding the self-employed health insurance deduction. We're limited on the types of insurance that can be claimed for this, and who it can cover, and then of course it has to be established under the trade or business, and we'll talk about that. So the types of insurance that qualify for this deduction would be regular old health insurance, dental insurance, vision. It could be a supplemental insurance plan, a limited coverage insurance plan. It could be for long-term care, although there are some extra limits to that, and we'll go over those a little bit more in, again, the itemized deduction lesson. And it could also be for voluntary Medicare payments. As far as people that this plan can cover, it can be the taxpayer. It can be the taxpayer's spouse if they're married filing jointly. It could be a dependent, and it could also be a child who is under 27 but not a dependent still. And then as far as established under the trade or business, what that means is it would be under the taxpayer's name. It could be under the spouse's name, again, if they're married filing jointly, or it could be under the business's name. Now, if any one of those people that we talked about before that could be covered under this plan, the taxpayer, the spouse, the dependent, the child under 27, if they are eligible to be covered through their employer in a subsidized plan, the taxpayer is not able to deduct the cost of the insurance paid for that person. So that's calculated on a monthly basis. So if in some months the child under 27 had another job and they could have gotten insurance through their employer, then the cost of their health insurance paid by our taxpayer would not be able to be deducted from the taxpayer's income. And then a scope issue with this is that if we have somebody who was insured through the marketplace, remember our Obamacare plans, if they were insured through the marketplace and they qualify for the premium tax credit, that is a return that we will need to send somebody to a paid preparer to assist with. So that kind of wraps up for this lesson, our self-employment kind of topics. Then we have a couple of adjustments that have to do with special tax favored accounts. So we have HSAs, which are health savings accounts, and we have IRAs or individual retirement arrangements. Both of those are tax favored accounts, and if our taxpayers contributed to them, they may be able to take an adjustment. If we go back to our form, our Schedule 1, we can see here where those adjustments show up. Line 13 is for the health savings account deduction, and you can see that flows from another form, Form 8889, which we'll look at. And then line 20 is for the IRA deduction. So again, our health savings account is a tax-favored account. It's a very tax-favored account. The contributions to that account are not taxable as long as they are within the limits. The earnings on the money in that account they are not taxable as long as they are kept in the account, or if they are distributed for unreimbursed qualified medical expenses. Unused funds can carry over from year to year with no limit. Earnings carry over from year to year with no limit. So you could see if this type of account were to be contributed to like as if it were a retirement account, and the funds were invested, that this could be an account that could build up quite well over time. And again, distributions are not taxable if used for unreimbursed qualified medical expenses. So what little bit we talked about IRAs, especially traditional IRAs, remember if the distributions are taken, then the earnings are taxed. And so this is kind of a double haven. It's not taxed going in, it's not taxed coming out, so long as the rules are followed. To be eligible for a health savings account, our taxpayer will need to be covered by a high deductible health plan on the first day of any month that they are contributing to this account. Again, this is figured on a monthly basis, not a yearly basis. They can't be covered by any other health insurance. There's a little additional information in publication 969 on some exceptions to that. They would not be enrolled in Medicare. The individual can be HSA eligible for the months being covered by Medicare. And they cannot be eligible to be claimed as a dependent on someone else's tax return. As promised, here's our Form 8889 for health savings accounts, and you can see it's divided into 3 parts. Part 1 is where it calculates the contributions and the deduction. Part 2 figures any taxable distributions and if there were penalties involved. There's an additional 20% tax if distributions are taken for non-qualified expenses. And Part 3 calculates the penalty if the individual had the wrong type of health plan. This account can be held by someone with a non-high deductible health plan, but they cannot contribute to it unless they have the high deductible health plan. So there's an important distinction there. And there are many different ways that money can get contributed to these accounts. Some of them will result in an adjustment and some of them will not. So an individual may make a contribution on their own. They could receive contributions from family members or really anyone else. And those types of contributions would end up as an adjustment on the return. However, if the contribution was made by an employer or the employee through their employer, there would not be an adjustment on the return because the employer already decreased the amount of income that they reported in box 1 of the W-2. And we recognize this kind of situation because on the W-2 in box 12, there will be a code W with the amount next to it that was contributed to the health savings account. So a form that some of our taxpayers may come in with that's associated with these contributions, aside from the W-2, is this Form 5498SA. And you'll notice up there in the right-hand corner that it says information. And this form is just informational. It's not required to be on the return. It's not required to file the return. So when our taxpayers come in, we say, oh, that's nice, and we hand it right back to them. Now, as I talked about earlier, this health savings accounts are highly tax-favored accounts, and so of course there's going to be some contribution limits, and that depends on whether the taxpayer has self-only coverage, family coverage, if they're 55 or over. Now, another important point to note is that these accounts are owned by a single individual. So if you have married individuals filing jointly, things can get a little complicated. I would refer you to publication 979. If you have married individuals and they have two health savings accounts, you'll want to look in that publication to help guide your process. But just kind of to give us a general overview, if our taxpayer has self-only coverage, they will be limited to $3,600 in contributions for the year. For a family, that's $7,200. And if they are age 55 or over, there's an additional $1,000 per account. And again, that if it's a married situation, each spouse is measured by their own age. So it's on an individual level for that. But these contribution limits are for 2021, so in 2022, expect to see something slightly different. So that's the contribution side. Let's look at the other side, distributions. So what happens when we take money out of these accounts? Now, in order to not trigger any taxes and any penalty taxes, distributions need to be for unreimbursed qualified medical expenses. And it matters who they are paid for, so it needs to be the taxpayer or the taxpayer's spouse if they're filing jointly, or it could be a dependent. And that would be at the time the expense was incurred. So for instance, if you have a dependent who gets some medical treatment on December and the bill doesn't come until the next year, and that next year that dependent is no longer qualifying as a dependent, the taxpayer is still able to have that tax-free amount, because at the time the expense was incurred, the person receiving care was a dependent, even though it was paid later, in a later year. And it doesn't matter whether the plan was for self-only coverage or for the family, as long as that person receiving care is on the return, then it's a qualified expense. So what are the kinds of expenses that are considered qualified medical expenses? So it could be fees for doctors, hospitals, dentists. It also includes equipment, supplies, diagnostic devices, but they need to be primarily to alleviate or prevent physical or mental disabilities or illness. So things that are for general wellness, like vitamins or gym fees, those don't count, but a lot of other things do count. Probably too many to list on a slide. So again, I would refer you to publications 979, and especially publication 502 has a much more extensive list of the types of expenses that are qualified medical expenses. And then new with the CARES Act, so after 2019, there were some additions to what qualifies as a medical expense. So anything to do with menstrual care and over-the-counter medications are able to be used as qualifying medical expenses. And then our taxpayers who had distributions from these accounts will come in with, or should come in with, a 1099 SA. And that will have in box 1 a gross distribution amount, and then there are some codes associated with this. A code 1 is a normal distribution in this case. And this is an important form to have reported on the tax return. So this is one that is needed. So on to IRAs. Now, if you remember back to our basic lessons on retirement income, we talked about some different kinds of IRAs. There's traditional IRAs and there's Roth IRAs. And traditional IRAs, the contributions may be deductible as an adjustment to income. Roth IRAs, however, that's not the case. The contributions are not deductible. So again, with a tax-favored account, we're going to have some contribution limits. And some of those contribution limits are that the taxpayer cannot contribute more into a retirement account, an IRA, than they received in compensation. And that might be wages, that might be business income, could be a number of places that they're getting income as compensation or earned income. And the contribution limit or the deductible limit is the lesser of the contributions or the general limit reduced by Roth contributions. So the rule with IRAs is it doesn't matter how many IRAs you have, there's going to be a general limit that changes each year, just similar to the HSAs. But it doesn't matter how many accounts you have, there's a global limit to how much you can put, regardless of whether it's a traditional IRA or a Roth IRA. For 2021, that global limit, if the taxpayer is under the age of 50, is $6,000. If they are over the age of 50, then they get $7,000. And here again, like HSAs, IRAs are not owned jointly by spouses. Each spouse has their own account. And in this case, each spouse will have their own limit. So spouse 1 has a $6,000 limit, spouse 2 has a $6,000 limit. And the age of 50 or greater, the extra contribution, the catch-up contribution for that is calculated on each spouse separately. It's an individual retirement account. Now, that global contribution limit can get a little more complicated. There are phase-outs, and those phase-outs are based on a modified adjusted gross income and whether the taxpayer or the spouse is covered by a retirement plan at work. I took a table here from publication 590A. It is not the only table associated with this. Generally speaking, for the type of clients that we're going to be seeing, we're not going to be seeing a lot of phase-outs, but just so that you know, if we have taxpayers who are covered by a retirement plan at work, it's possible that there could be limits to the amount of deduction they could take. And then as far as timing contributions, there used to be an upper limit on the age you could be and still contribute to an IRA. That was gotten rid of by the Secure Act, so even older people who are retired could technically still be contributing to their IRAs. And then the taxpayer has up to the original due date of the return. So even if, you know, December 31st has passed and they haven't made a retirement contribution, but they intend to make a contribution before the due date of the return, so April 18th for this year, then they would be able to deduct that on their return. And that's not a completely uncommon strategy. A lot of times taxpayers want to wait and see what their tax will be, or their tax is going to be a little higher than they thought, and so they decide to lower the amount of tax by making a contribution to an IRA, and then they have up to the original due date of that return. So, and lastly, as we talked about, there are limits to how much of a contribution could be deducted, or there may be excess contributions that weren't allowed. These situations would require Form 8606, which is out of scope for us. So if we're looking at somebody who is made some non-deductible contributions, then they will have basis in their IRA. They need to see a paid preparer to help with that. And with the excess contributions, there can be a tax associated with that, an extra tax, which we'll talk about in a later lesson. But if they're going to have that tax, then that return would also be out of scope. So now that we've expanded our knowledge of adjustments to include the self-employment tax adjustment, the self-employed health insurance adjustment, contributions to both HSAs and IRAs, here's what I want you to do. Head on over to Link and Learn and answer the skills check questions. There's just 3 of them. If you are in Accounting 496, don't go there. In Canvas, you'll have a 10-question quiz covering what we covered in the video. And then in TaxSlayer, we have a return that you can enter, a practice return with an HSA. And as always, remember your resources. For this lesson, we had a few extra resources. So along with our publication 4012 and 4491, we have publications 979 and 502 covering those HSA situations and what's a qualified medical expense. And then for our retirement accounts, we have publication 590A. So those resources are always available. They're available to you in the field while you're taking the exam anytime.